Imagine waking up one morning, opening your banking app, and realizing that everything you thought was stable, your job, your savings, your retirement account, is quietly bleeding out. You didn't see it coming. Most people never do. And that's exactly the problem. Because right now, in February 2026, the U.S. economy is sending signals that millions of Americans are either ignoring or simply don't understand. Not hype, not politics, not media noise. Real data, real warning signs, and a very real question that deserves a serious answer. Is America quietly sliding toward a recession in 2026? Stay with us, because by the end of this video, you'll know more about the direction of this economy than 90% of the people around you. Before we get into the warning signs, we need to understand exactly what we're talking about. The word recession gets thrown around constantly, on cable news, in headlines, at dinner tables. But most people have never been given a clean, honest definition of what it actually means. So let's fix that right now. Technically speaking, a recession is defined as 2 consecutive quarters of negative GDP growth. GDP, or gross domestic product, is the total value of everything an economy produces: goods, services, salaries, investments. When that number shrinks for 6 months in a row, economists officially declare a recession. But that technical definition is just the beginning of the story. In practice, a recession feels like something much more personal. It's rising unemployment, where companies that were once hiring start quietly laying people off. It's falling consumer spending, where ordinary people stop buying things because they're scared or simply broke. It's businesses pulling back on investment, canceling expansion plans, and tightening their belts. And it's a stock market that turns volatile, punishing retirement accounts and investment portfolios without warning. The last major recession most Americans remember hit in early 2020, triggered by the COVID-19 shock. A moment so sudden and so severe that GDP collapsed at an annualized rate of over 30% in a single quarter. Before that, the Great Recession of 2008 wiped out trillions in household wealth, crashed the housing market, and sent unemployment surging past 10%. Both of those downturns had one thing in common. The warning signs were there before the collapse. Most people just weren't paying attention. That's why we're paying attention right now. Here's the thing about the current economic moment. On the surface, it looks okay. The stock market closed 2025 with an S&P 500 gain of just over 17.9%, the third consecutive year of double-digit returns. Corporate profits are still rising. Layoffs, while creeping up, haven't triggered mass panic. And the Federal Reserve, after 3 consecutive interest rate cuts in late 2025, has settled the federal funds target rate into a range of 3.5% to 3.75%. On paper, that reads like stability. But here's where the story gets interesting. Underneath those headline numbers, the foundation is shakier than it appears. Real GDP growth is expected to slow to somewhere between 1.4% and 2.3% in 2026, depending on which forecaster you ask. Deloitte sits at the more cautious end, projecting just 1.4% growth, noting that higher tariffs and reduced immigration will keep inflation elevated even as the economy cools. The unemployment rate has already ticked up to 4.4%, compared to 4% just a year ago, and is forecast to reach 4.5% before the year is done. Consumer spending, which drives nearly 70% of America's entire GDP, is expected to slow to just 1.6% growth in 2026, cut nearly in half from its 2025 pace. And Moody's Analytics puts the probability of a 2026 recession at approximately 42%, while JP Morgan estimates a 40% chance of a U.S. and global recession. In a healthy economy, that recession probability would sit closer to 15%. We are not in that comfortable zone right now. If you want to understand the American economy, you have to understand the American consumer, not the wealthy investor, not the Wall Street trader, the regular person, the one buying groceries, paying rent, putting gas in their car, and swiping their credit card for things they used to pay for in cash. That person is the engine of the U.S. economy. Always has been. And right now, that engine is showing signs of serious strain. Here is the uncomfortable truth that most financial media won't say plainly. The consumer spending numbers that have kept the economy looking resilient are increasingly being held up by a very small group of people. According to Moody's Analytics, The wealthiest 10% of Americans now generate nearly half of all consumer spending in the country. Evan Sheehan, consumer products leader at Deloitte, put it directly. I think the bottom half of the economy is already in recession to some extent. Think about what that means. While headlines celebrate consumer resilience, tens of millions of ordinary Americans are already living in their own private economic contraction, stretched thin by credit card debt, drained savings, and wages that haven't kept pace with what things actually cost. American households have been carrying record levels of credit card debt. With interest rates still elevated, that debt is expensive to carry. And as savings built up during the pandemic years have been spent down, there is less and less financial cushion for working families. When people are leveraged this heavily, it doesn't take a dramatic shock to trigger a spending pullback. All it takes is a few months of job insecurity, a medical bill, or a jump in rent. And when 70% of your economy depends on people spending money they are increasingly struggling to hold on to, you have a structural vulnerability, one that can turn a slowdown into something much more serious very quickly. Turn on any financial news channel on any given morning, and you'll hear the phrase, "The labor market remains resilient." And technically, that's still true. Layoffs are not at crisis levels, and the official unemployment rate hasn't spiked dramatically. But the moment you look past the headline unemployment number and into the actual anatomy of the job market, a very different picture begins to emerge. Average monthly job growth since April of last year has been just 17,000 new positions, a number that, in any other decade, would set off alarm bells in every boardroom and every government office in Washington. The reason it hasn't is largely because the dramatic slowdown in immigration has changed what a normal number for job growth looks like. But here is why that explanation should not make you feel better. A job market that barely replaces itself is not a job market that can absorb an economic shock. The unemployment rate for workers between the ages of 16 and 24 has been above 10% and rising for 6 consecutive months. The share of unemployed workers who have been out of a job for 6 months or more is tied with the pre-2009 record, the last time the economy was on the edge of the worst financial crisis in a generation. And hiring, while layoffs stay low, is also at its lowest low in decades. What you get from that combination is a labor market in a state of frozen tension, not collapsing, but not growing, and deeply vulnerable to any disruption in policy, trade, or business confidence. There is a third force working against the American economy in 2026 that doesn't show up cleanly in any single data point, but shows up everywhere when you know where to look: policy uncertainty. The trade tariff volatility of 2025 introduced a level of anxiety into the business community that genuinely disrupted investment planning. Companies that typically think in 5-year windows were suddenly making decisions quarter by quarter, trying to front-load equipment purchases before new tariffs hit, repositioning supply chains, and holding off on hiring commitments they weren't sure they could sustain. While many of the most aggressive tariffs have since been walked back or granted exemptions, the damage to confidence has been real. Deloitte notes that the average effective tariff rate going into 2026 will still be higher than it was before, in part because companies cannot repeat the inventory front-loading strategy that cushioned the blow in 2025. Add to that a 43-day government shutdown in late 2025, the longest in U.S. history, and you begin to understand why business investment in structures fell 5% in 2025 and is expected to grow by only 0.4% in 2026. Residential housing, meanwhile, remains frozen. Permits are down nearly 10% year over year. Housing starts have consistently underperformed. Mortgage rates, though lower than their 2023 peak, remain elevated relative to inflation and actual income growth. The construction industry has been hit by the combined pressure of deportations affecting the labor supply and new tariffs on lumber raising material costs. For millions of Americans hoping to buy a home in 2026, the door remains stubbornly, painfully shut. Here is where we have to be completely honest with you, because this channel deals in data, not drama. Not every economist believes a recession is coming. In fact, the majority consensus, as of early 2026, is still that the U.S. will avoid an outright contraction. Analysts surveyed by Bloomberg are forecasting 2% GDP growth with roughly a 30% chance of recession. Fidelity's institutional portfolio manager Lars Schuster has said plainly, while some areas of the economy are slowing, in our view, the U.S. economy is still in an expansion. We don't see signs of an imminent recession. The Fed's own 2026 GDP forecast sits at a more optimistic 2.3%. There are real reasons for that optimism. Corporate profits are still rising. The massive wave of artificial intelligence investment, with hundreds of billions of dollars flowing into data centers, semiconductors, and infrastructure, is adding real economic momentum that didn't exist in previous cycles. The tax cuts passed through the One Big Beautiful Bill Act have the potential to boost consumer spending power over time. And the Federal Reserve still has room to cut rates further if the economy deteriorates, a tool it used effectively through the second half of 2025. The U.S. economy is genuinely resilient in ways that many other economies simply are not. Its capital markets are deep, its institutions are strong, and its capacity for innovation remains unmatched. But resilience is not immunity. And the window between a slowdown and a recession, between 1.4% growth and negative growth, is narrow enough that any one of those four pillars, the labor market, inflation, consumer spending, or AI investment, stumbling in the wrong direction could push the economy over the edge. Moody's chief economist Mark Zandi put it simply, nothing else can go wrong. Like, nothing. We're pretty much on the edge. So what do you actually do with all of this information? Because knowledge without action is just anxiety. And the goal here isn't to scare you, it's to prepare you. The first and most important thing that financially smart people are doing right now is reducing high-interest debt. If you are carrying a balance on a credit card at 20%, 22%, or higher, every month you carry that balance is a month where the bank is winning and you are losing. In a potential downturn, that debt doesn't disappear, it accelerates. Pay it down aggressively while you still have stable income and the time to do it strategically. The second thing is building an emergency fund with genuine depth. Financial advisors typically recommend 3 to 6 months of expenses in liquid savings. But in an environment where the job market is this tight and hiring this slow, 6 months may not be enough for everyone. If you work in a sector that tends to contract during downturns, retail, real estate, finance, media, or technology, think seriously about pushing that number higher. Not because a layoff is guaranteed, but because the cost of being unprepared is almost always higher than the cost of being cautious. Third, for those with investment portfolios, now is the time to review asset allocation. Not panic sell, but review. Some market sectors are historically more defensive and tend to hold value better during recessions. Consumer staples, utilities, and healthcare are examples. Chasing high-growth bets in a slowing economy carries more risk than it might have during the bull run. And if you have been thinking about diversifying your income through a side project, a skill you can monetize, or a small business, the case for doing that before a potential downturn is stronger than it will be after one. The U.S. economy is not in free fall. It is not 2008. It is not the edge of a cliff. But it is walking a tightrope, and the winds are picking up. Consumer spending is slowing. Job growth is historically weak. Policy uncertainty is suppressing investment. Inflation remains stubborn. Moody's puts recession odds at 42%, J.P. Morgan at 40%, and Deloitte projects the economy growing at just 1.4% this year, a number that leaves almost no margin for error. Economic cycles are not a myth. They are not invented by the media. They are one of the most well-documented patterns in modern history. And the people who tend to come through them best are not the people who predicted the exact date things would break. They are the people who paid attention to the signals early, made smart adjustments while they still could, and refused to let either panic or complacency make their decisions for them. That is what endless economies is built for. Not fear, not noise, not politics, just the signals you need, explained clearly, so you can make better decisions with your money and your future. If this video gave you something worth thinking about, subscribe, share it with someone who needs to hear it, and stay tuned, because in the world of money, information is always power.